This Week in Economics from WBRN Radio and on the Bostonred Network. Today's date, the 23rd of May, 2019. We have the new job figures out from the Bureau of Labor Statistics. We'll also hear from James Bullard. He's the chair of the Fed in St. Louis, the St. Louis Fed, in other words, talking about interest rates and inflation. Inflation is historically low, and we'll also hear from Warren Buffett, at least via Reuters, his take on interest rates and where they are, or inflation, I should say, which are inflation interest rates. The Fed has a dual mandate of maximum unemployment and stability in terms of inflation. So they are looking after that mandate. There was a meeting on Wednesday. We'll have edited version, or perhaps the full version, of Chair Powell's news conference. They now give a news conference after each meeting, and he'll be talking about some of the same issues as where inflation is. He called it transitional. In other words, up and down. It sort of matches with our seesaw model by Cranston Analytics, which the economy is up and down. And from Bullard has projections along with many others at 2.5, and it could be 3, that is for the entire year, in terms of GDP. Our view is a much more cautious view than that, perhaps. And we'll hear from Warren Buffett, or at least some things Warren Buffett would do. We have an interesting little segment here from Quantize, which is an analytics group using artificial intelligence. They look at 20 selections Warren Buffett could make. Kind of interesting there. We'll be watching their sites and see where we are basically going. Pretty gang-packed for this particular one in terms of statistics. We are always prone to look at AI and what AI is doing, what the market is doing in terms of the market. Now models are looking at the market and many other things that at one time they did not. So what level of significance the Fed plays in this? A lot of that is from older days when the Fed was the whole ball game, so to speak, and interest rates rising there. If you look at such things as the Phillips curve, Bullard will talk about that. And we also see very interesting situation he was talking about with as far as inflation is concerned, being 100 basis unemployment, being 100 basis points above what they call the natural rate. We talked about that before, where it should be. It's at 3.6. Does 3.6 matter very much between 3.5 or 3.4? Not in the big scheme of things. You get in the 3-point range, it becomes a normalized range. In other words, under G.W. Bush, full employment was at 4.5%, whereas we looked at it under Lyndon Johnson as being basically about 2.5 as a full employment. Now, we haven't engaged the full employment situation, but we've been below 4% at 3.6 and perhaps 3.5 at the end of the year. How many jobs are added? Well, we'll get to that. Basically, Bullard was saying 210 jobs. I'm not working for my notes here from memory. And let's go to the report here, and we'll talk a little more here. This is released on Friday the 3rd of May. The employment situation will start out with two versions of this. And I'm not certain, we've talked about this before, the non-farmer payroll. There aren't very many farmers out there to have a payroll, 263,000 in April. The unemployment rate being at decline to 3.6. Notable job gains where they occurred. We'll get into that in a second also. This news release presents statistics from 2 monthly surveys. The household survey measures labor force status, including unemployment by demographic characteristics. The establishment survey measures non-farm employment, hours, earnings by industry there. So we'll now the household survey data. The unemployment rate declined by 0.2% to 3.6 in April, lowest since December of 1969. And one note, in December of 1969, the economy was much, much smaller. Today, what is it at, 23 or so $trillion? I don't remember what it was at that time. The number of unemployed persons decreased by 387,000 to 5.8 million. Amongst the major groups, we look at that. Adult men at 3.4%, a little bit better. Adult women are beginning to do much better at 3.1%. For Europeans, 3.1%. For Asians, 2.2%. And for Latinos, 4.2%. The jobless rate for teenagers still much too high at 13%. For African Americans at 6.7%, and showed little change there. It has been historically roughly almost double for the other groups. Unemployment numbers of job losses and persons who completed temporary jobs declined by 186,000 over the month to 2.7 million. In April, number of persons unemployed less than 5 weeks declined 222,000 to 1.9 million. The long-term unemployed, those employed more than 27 weeks, or 1/2 of a year, was little change at 1.2 million in April, accounting for 21% of the unemployed. The labor force participation rate declined 0.2%. Percentage points to 62.8% in April, but was unchanged from a year earlier. The employment population ratio was unchanged at 60.6 in April, and has been either 60.6 or 60.7 since October of 2018. Number of persons employed part-time for economic reasons, sometimes referred to as involuntary part-time workers, was little changed at 4.7 million in April. 1.4 million persons were marginally attached to the labor force, a little different from a year ago. So you're seeing that changes here are not significant. Among the marginally attached, 454,000 discouraged workers in April. That's basically 500,000 workers, unchanged from a year earlier, so that has not changed. Now to the establishment survey, the increase 263,000 in April, compared with a monthly average of 213,000 over the past 12 months. In April, notable job gains occurred in professional business services, construction, healthcare, and social assistance. Professional and business services added 76,000 jobs in April. Within the industry, employment gains occurred in administrative and support services. That was 53,000 there. In computer design and related services, 14,000. Over the past 12 months, professional business services have added 535,000 jobs, or 500,000 jobs. Construction rose by 33,000, with gains in non-residential trade. Contractors at 22,000, and heavy and civil engineering construction at 10,000. Construction has added 256,000 jobs over the past 12 months. Healthcare, 27,000 in April and 404,000 over the past 12 months. April's jobs occurred ambulatory health services, 17,000, medical centers, 8,000, community care facilities for the elderly at 7,000, social assistance added 26,000 jobs over the month, with all gains in individual and family services. Financial activities employment continued to trend up, 12,000 added. Industry added 110,000 jobs over 12 months, almost 3/4 of the growth in real estate, rental, and leasing. Very interesting there. Manufacturing, little changed in the 3 months. 4,000 jobs added in April. In the 12 months prior to February, the industry added 22,000 jobs per month. Down. Manufacturing is starting to show its true nature. Employment retail changed a little, negative 12,000 jobs. Job losses occurred in general merchandising stores, 9,000, while motor vehicles and parts dealers added 8,000. Employment in other major industries, mining, wholesale, transportation, warehousing, information, leisure, and hospitality and government, showed little change. The average hourly earning for all workers on private payrolls rose by 6 cents to $27.77. Over the year, average hourly earnings increased 3.2%. The average hourly earning in production and non-supervisory employees increased 7 cents to $23.31 in April. The average work week for workers decreased by 1/10 hour to 34.4 in April. In manufacturing, both work week and overtime was unchanged at 40.7 hours and 3.4 respectively. The average work week for production non-supervisory workers on private payrolls held at 33.7. The change in total non-farm employment in February was revised up from 33,000 to 56,000. Not unusual that ahead of these revisions. The change for March was revised down from 190,000 to 189,000. With these revisions, employment gains in February and March combined were 16,000 more than previously reported. You'll see some of these revisions coming out. The next scheduled release is on the 7th of June, 2019. So we won't go into the charts for brevity here. Some losses, some quits. We'll just append this and move along happily, as one would say. We'll get to Bullard later. We'll actually hear his interview from Bullard. Sinclair, that's a broadcasting company. We're on some of their stations by 22 regional sports networks, from the Disney at 10.6 billion valuation there. Adjusting for minority equity interest, Sinclair said it's buying assets for 9.6 billion. The broadcasting company said the networks have at least 74 billion subscribers and brought in 3.8 billion in revenue in 2018. The deal requires approval from the Justice Department, part of the divestiture going on here. Disney divested the network when it bought TV and film assets from 21st Century Fox. That was a $71 million deal. There were various people buying for these networks, including the entertainer Ice, known as Ice Cube. And this is an interesting thing here. These are stocks Warren Buffett would buy if he were a quant. It's quantitative. This is a quantitative firm named Quantumize. Created a Warren Buffett portfolio of 20 stocks. Won't get into most of them, but traditional ones in there: Johnson & Johnson, Lockheed Martin, tech leaders, Alphabet, and eBay, as well as Planet Fitness. Not sure about that one. But Warren Buffett, 88 years old, Oracle Omaha stock picks have always been about finding intrinsic value. He has long been a champion of long-term concentration, bets on big value companies like Coca-Cola, Bank of America. Well, Coca-Cola has been adjusting its business model, selling less Coca-Cola than other more fruit-oriented drinks as what the rest of the world drinks, but they're still on the artificial side. In the top of the list here, Johnson & Johnson. Of course, Johnson & Johnson, huge lawsuits on their talcum powder and various other things having asbestos in it. Lockheed Martin, a military contractor. I should give the percentage here, 15.52%. Lockheed Martin at 13.51. Boston Scientific at 9.19. Excuse me. eBay at 7.66. Brookings Holdings at 7.02. Marriott International, where are they? 4.6%. Planet Fitness of all at 4.43%. Big part of the industry these days. And Alphabet at 4.6 there. Intel at 3.27. And PGEP at 2%. Skywork Solutions at 2%. And TI, Texas Instruments, been around a very, very long time at 2%. This is some of his large ones here. A quantitative investment research firm created this model, screening a large cap stock universe with traditional value factors like free cash flow, earnings yield, as well as the element Buffett has been vocal about: economic value added. Well, no doubt about that. The portfolio turned out to be a mixture. We already talked about that. It's almost like Buffett meets Joel Greenblatt, and Greenblatt and his Greenblatt cap annual return of 40%. That was from 1985 to 2005 with his index fund, and then later created a called a magic formula investment stock screen. Some others have followed his style there to find the Buffett-like stocks. Quantumize used AL deep learning that picked stocks based on sell side sentiment, Google searches, interesting here, options, and market data. That's what the algorithms were able to do. Then the firm used AI cluster optimization technology to create different weights. It's sort of the same thing that a pollster actually would do. Buffett has been transparent about what he uses. Economic value adds a measurement of value being accreted to stockholders. It's the confidence he has held in a lot of companies where he's a core investor. Economic value adds a complicated metric that seeks to show how much a return a company is generating above the cost of capital. All this seems unlikely, but Buffett would own eBay or Alphabet, given his usual aversion to tech stocks. He might be slowly warming up to the sector with his huge investment in Apple. Well, Apple's a very interesting company, as is Microsoft. All these companies have strayed away from their business models. They're going more to services, specifically software as a service, value-added service, and old resellers model from yesteryear. Nothing is new about that. It's just that they're moving away from it. And in the case of Apple, its dependence on the iPhone, you can only sell so many. And with Microsoft, it used to be that their Windows operating system, their Office operating system, and now the Office 360 as a software as a service. The operating system is going to software as a service. And when you look at the number of smartphone platforms which run on Android, to a lesser extent on Apple's iOS, the core software becomes less of an issue. The latter two are given away, Android and iOS, as just part of what you get on your smartphone, tablet, or whatever you get it on. Whereas the Windows proprietary system still will cost you about $100 or so if you didn't upgrade when the upgrade went out there. But they are moving towards you, and it's more towards that now. You be getting it just as a service and nothing else. So that in itself has changed their whole model. If you look at Amazon, they've been buying some Amazon. Amazon is basically, other than being a giant marketplace, started out just a bookseller. Their Amazon Web Services is more and more the unit that is bringing in the dollars in the future. So what we're seeing is a return, very interesting here, a return to yesteryear. I remember starting out there, we rented space on mainframes, or got space in the university lab to get on the VAX or whatever we had. And that was how we did our research on that time. Now going back to that particular situation, when you go to the cloud, there was an interesting story, I guess you'd call it, on the BBC, I believe, on Greenland, and the number of data centers being located there. Of course, obviously you have thermal issues, and there it's a very cold climate, so they're able, by using turbine power to cool the systems, at the same time to use the heat to operate the system. So two different things, and more of those huge data centers are locating there. So we're getting more ecological favored type of development here, more sustainable development coming online. And this is one of the things that harps back to this whole debate on where inflation is, where inflation is not. That's why Chairman Powell called it transitory, and they are looking at it. And as business models change, and they are changing, and some more drastically than we normally see them changing. Let me get to Warren Buffett. We'll preview this. We'll at some time have the annual meeting there in Omaha, Nebraska. Incidentally, will be televised on Yahoo, as far as I know. There are 5 issues you'd want to issues Berkshire Hathaway's stock holders, what do you want to call them, want to get more information on. They include the underperforming relative to the broader market, and what Buffett would do with the company's mass cash reserves. Well, he has mass cash reserves, no doubt about that. Continue to underperform the broader market. Investors want to know why. Second is sitting on $100 billion. And there's also the Kraft Heinz issue. They took a massive stake in the Kraft Heinz, the ketchup company's food types are there. The S&P is beating Buffett. Buffett shares are up more than 1,000,000% on the book value. That's since 1964, according to the latest annual letter that he sent out. And in the time, the S&P 500 is only up 15,000%, including dividends. But that hasn't been the case recently. Total returns are trailing the S&P 500 over the past 1, 5, and 10 and 15 years. For example, a $1,000 investment in a Berkshire in 2009 would be worth more than $3,500 now. Meanwhile, the same investment in the S&P 500 would be worth more than $4,000. If my arithmetic doesn't fail me, you'd get $500 more. But again, that would all depend on many other things. Over this period, shares of tech companies like Microsoft, Apple, and Amazon have surged, lifting the S&P 500. Buffett, meanwhile, has largely avoided them, as reported earlier. CNBC reported that one of Buffett's investment started buying Amazon shares. The stocks definitely underperformed, and people will definitely want to get a handle on why it's happening. Stockholders will want to know more about $112 billion in cash that they have. Well, Warren Buffett's looking for a big deal. But Buffett has hinted that the money could be spent other ways through buybacks. He bought back $1.3 billion in shares last year. But Buffett in the letter said it was likely that Berkshire Hathaway would buy back more stock in the future. Financial Times also reported that Buffett said, without providing any time frame, the conglomerate could repurchase $100 billion in shares. I'm not opposed to them buying a lot more Berkshire. That's from Trip Miller, his managing partner of a Gallant Capital Partners, which owns Berkshire Hathaway stock. Buffett told the stockholders' annual letter, which we reported on, took a $3 billion hit in the fourth quarter after the Kraft Heinz cut their value of its Oscar Mayer brand and Kraft brands by $15.4 billion. That was where he partnered with a 3G Capital, private equity firm from Brazil, which acquired Kraft in 2013. 2 years later, Berkshire helped to finance Kraft's $49 billion merger with Heinz. Stock has lost half of its value after the merger. Buffett told Becky Quick, she'll be with him tomorrow, that Berkshire Hathaway overpaid for Kraft but not for Heinz. Kraft Heinz recent troubles have raised concern about Berkshire's partnership with 3G. Now he's in the oil business with Occidental Petroleum. I remember, I forget the fellow's name, but was chair of Occidental Petroleum, a progressive person. After Chernobyl, he flew to Moscow to assist in that. But nonetheless, they've been around for quite a while. Now they're acquiring Anadarko Petroleum. The investment placed Berkshire in the middle of a bidding war between Occidental and Chevron, and they won out. Has offered, which had offered $33 billion in cash in stock for Anadarko. It's rare for Berkshire to get involved in a bidding war. The structure of this deal is classic Berkshire financing transaction. Through terms of a deal are not attractive as some of in the past. Well, they're pretty shrewd about this. Shrewd, I should say. They got into a deal with Goldman Sachs to provide capital to them and came out on top. Succession, who knows? We won't even get into that one. And let me check our time here because we have some add-ons. Before we do numbers, I guess talk a little about a unit of Goldman Sachs that nobody knows about. Secretive tech fund inside of Goldman Sachs transformed the bank and returns 25% a year. Somewhere on the West Side Highway in Manhattan, there's a group that is there. They're called the Principal Strategic Investments. That's what the team is called. Run by a partner named Daryl Cohen. And he has $1.5 billion invested in 76 companies, including GitHub. Beside funding tech solutions for Goldman, the group earns a tighter return. The bank, PSI, 25% is very, very good indeed. No doubt about that. It's 28 people on this team. I'm reading from CNBC, incidentally, here. Some in recent years, PSI gathered a roster of portfolio companies from digital mortgage firm Better.com to robo-advertising advisors, Nutmeg, that may provide clues on Goldman's future move into consumer finance. So they're in the digital business. A lot of people are moving into it. It also tacitly acknowledged that despite the fact that Goldman has 9,000 software engineers of its own, many problems are best solved outside the confines of the big bank. That's almost 10,000 software engineers. A lot of software engineers there. Kind of tells you where things are going. Tight-knit group hails from around the world, speaks 14 languages. So that's a lot of people there. And this is the way that things are going. There's no doubt about that. One of the largest and fastest growing global financial networks today, with 450,000 users across 350 institutional clients. Cohen says BlackRock and are both early investors in the user system. Let me get to what system this is. This is so did PSI. Sometimes Cohen took over PSI in 2012. In 2014, Cohen helped write the business plan on the wall of his office for an encrypted cloud-based messaging system. The ultimate became a Symphony, which is known as Slack for Wall Street and other heavily regulated platforms. Last year, Symphony was valued at $1 billion. So a lot of networks we don't know anything about, and or the public doesn't as a whole, and now we know about them. And this is what we attempt to do here on Numbers Man, is find some of these things. Let's go and do the numbers. We'll go to the BBC to perform this little task. Then we'll go on. The St. Louis Fed and chair of the Fed, Jerome Powell, Bullard of St. Louis. The FTSE was 0.40%. That's the FTSE 100. In Amsterdam, they had 0.39%. In Paris, at 0.18%. The DAC at 0.55%. The Eurostas at 0.39%, and in Madrid they were down not 9% there. In Bombay, another down market at not 5%, and negative in Hang Seng at 4.6%, and the Nikkei was also down on Friday at 0.22%. And to the Dow Jones, it was at 0.75%, and the Nasdaq at 1.58% there, and the S&P 500 at 0.96. Jump to commodities. Brent crude was up 10 cents, I guess, at $70.85 after dropping. That the change was 0.14%. West Texas crude was at $61.94, up 13 cents. T-Bone Picken is still jumping for joy in his retirement. Gold down, let me see, at $1,270.95. That is on the Forex exchange there. So those are where that is where the commodities stand, where the markets stand. Very little progress there. It was not a banner week for the markets. They were more, I guess, what you'd call up and down. Look at U.S. markets. This is CNBC here. Basically the same thing here. We look at S&P. We got gold. Gold was actually up, according to this, $8.20 at $1,280.20. The U.S. 10-year Treasury, you have Bullard talk about that. It was down at 2.53. And the VAX was down also at 112.87. Commodities, did we do natural gas? It was also down 0.27. Silver, we haven't given that in a while, was actually up 0.333 at $14.95. Copper also was up. Wheat was down 6.50. Soybeans, we haven't given that in a long time, was also down 2.25 there. And corn was down. All these commodities at 0.25. And this is the rest of the treasuries. The 3-month note was also down. The yield on that was 2.434. The 1-year treasury was up at 2.490. That was the 1 year. The 2-year was down at 2.335. The 5-year treasury was also down at 2.327. The 10-year was down at 2.53. And the 30-year was also down at 2.922. Well, some of what was going on there with the Treasury, the euro was actually up at $1 at 1.120 in other words, and the U.S. currency was down, and it won't need to go any further than that. This will do it for this week's edition of our program. Numbers man here. As usual, we partner with Cranston Analytics on the 3rd of May 2019. We will have later today on our political side, later tomorrow actually, of This Week in Economics. Now, today we had Friday Jarvis, our political program. Invite you to stay tuned for it also. And we have international affairs on BR on the World, another part of the Bostonred Network. And on to Bullard, Chairman.
The Vice President on talking about the Fed and Fed policy, and I get to throw it at a president, a voting member of the FOMC, who says you ought to be lowering rates and maybe not considering the employment mandate, just have an inflation mandate. Take it away.
I actually have supported a single mandate for the Fed in the past. I've said that it would clarify what the Fed can actually do over the medium term. I don't think actual policy would change very much. We would still react to the economy and everything, but it would clarify in people's minds that the only thing the Fed can do over the medium term is try to control the inflation rate.
Do the President and the Vice President have a point that growth is strong, inflation is low, and the Fed ought to be cutting rates, and if it did cut rates, the economy would soar?
I think the way you have to think about the current situation, you have to step back a little bit. There's been a sea change in U.S. monetary policies since January 4th when the chair was at in Atlanta at the AEA meetings. That sea change has altered the structure of interest rates And you can really see it in the 10-year. The 10-year was trading at 325 last fall. Now it's trading low 250s.
It was high as 350 at a point.
You're talking 75 basis points on the 10-year. I would attribute the lion's share of that to changed Fed policy. We know there are long and variable lags. You got to wait and see how big an impact this has on the economy. So I think we're in great shape today. We've got a great jobs report. Inflation's a little bit low. We can talk about that, but we've already made a gigantic change in policy, which I welcomed and supported. Most of the committee came to my view about the flat rate outlook, and this has had a big impact.
So you're saying that you've already eased through what is sort of derisively called open mouth operations. By changing your stance on the forward outlook.
Policy isn't just the rate, it's the expected path of the rate over the next 2 years.
Right.
And we used to be saying, 50, 100 basis points on that path. Now we're saying zero or very close to zero on that path.
Down and real rates in the economy down.
Absolutely.
Let's talk about this jobs number. I mean, did your eyebrows go up sort of towards the top of your forehead when you saw
it's
260
It's a good number. It sounds like since the first of the year, we're about a 205 or something on average. A little bit lower than last year. So this is consistent with the idea that 2018 was going to be a little bit faster growth than 2019. I think the news in the last month, the news is that we're not going to get this slowdown to below 2% GDP growth. Instead, we're going to slow down to 2.5%, which is, more moderate type of slowdown in 2019 compared to what people were expecting.
I mean, I get that, but it looks more like we're closer to 3. I mean, we did 3 in the first quarter.
And there's upside potential that you could just stay at 3. You got this good productivity number, which I love. It looks like productivity is picking up. There could be supply side effects here that are kicking in, possibly because of the Tax Act. So I think some good things are happening, and it could be that you get even higher growth in 2019 than the numbers I just said.
Okay, so I'm going to get to Sarah in just a second. Sarah, if you would just with me, if you have a 2.5 forecast with a 3 upside, is 2.4 the current funds rate the right rate for that environment and that potential?
Well, I think we're a little tight on the funds rate, not too much, but a little bit tight. I think the global safe real interest rate, short term, is about 0. And if you
rate.
real rate.
So let's explain that to people.
The real rate is 0. If you add the 2% inflation target to that, you get to 2%. We're at 240. Sounds a little bit tight to me. I don't think it's something to really worry about, but it sounds a little bit tight. And you've got core PCE inflation running at only 1.6. It's making me a little bit nervous. I think inflation expectations are a little on the low side.
So do you agree with Powell that it's transient?
I would like to recenter inflation, take this opportunity to recenter inflation expectations at 2%. I think that would pay handsome dividends for the Fed going forward.
We'll come back to transient. Let's get Sarah's question. And sorry about that, Sarah.
Well, my question's on transient, Professor Bullard. I was wondering what you made of the market reaction to the Fed meeting. I mean, it seemed like there was some real disappointment in market positioning around the fact that Chairman Powell describes inflation as transient or transitory, and therefore suggested it's not persistent enough to make a rate cut.
Yeah, I think, again, we've made a big move in monetary policy over the last 3 or 4 months, and I think it's time to wait and see how that's going to impact the economy going forward. It's true that the core PCE numbers have come in a little bit light, but of course there is noise in the data, as the chair noted, and you could look at the Dallas Fed trim mean, which is a measure that I have liked in the past. That is at 2%. So I think this is a point where we probably want to be assessing the data. So,
Jim, if indeed we're going to be running 1.5 core PCE, which is the better measure you guys think of inflation, how tight is the Fed here? Do you think it ought to be cutting rates?
Well, like I say, I'm not averse to the idea that we should try to recenter inflation expectations while the economy is good and make sure that we're centered at 2%. They look a little light to me. It looks like markets expect, something below 2% inflation over the next 5 years. And I don't think that's a good place for us to be. There will be days in the future where the economy is not performing so well, and those expectations will go down even further. So I think it's a reasonable option is to try to recenter inflation expectations on 2%.
Tell us how, as a policymaker, you react when you hear the president talk about what the Federal Reserve should be doing with interest rates.
Well, as you know, all these discussions are get very technical very quickly, and so I think we have our mandate. We're supposed to get full employment. We're supposed to hit our inflation target and keep inflation low and stable. Many factors come into that. We get advice from all kinds of people, including you, and and including other politicians. You know, the chair goes before the Senate Banking Committee, House Financial Services Committee. They all comment on monetary policy. So we get a lot of input from a lot of different angles. We're used to that. And we try to make the best decisions we can. But we do have this mandate we have to come back to. That's in law.
All right, Jim, I want to see where your forecasts are here. We're at 3.6 now on the unemployment rate.
Yeah.
How low does it go, and at what level does it make you more nervous about the potential for inflation?
You know, I think we've talked about this before, but the empirical Phillips curve is very, very weak in this environment. You might be talking about a ratio of 10 to 1, so you'd need 100 basis points of gap to get 10 basis points on inflation. And, you know, what do you think? 3.6, is that 100 basis points below the natural rate? I don't know. So a lot of people think not. So how much inflation do you really think you're going to get out of this low unemployment rate in this environment?
And then before we go, real quick, your GDP number for this year?
I'd be at 2.5 sitting here today.
Great. Jim Pollard, thanks very much for joining us.
All right. Thanks
a lot. And we'll check back with you at the end of the...
At the FOMC meeting that concluded today, we reviewed economic and financial developments in the United States and around the world and decided to leave our policy interest rate unchanged. My colleagues and I have one overarching goal: to use our monetary policy tools to sustain the economic expansion with a strong job market and stable prices for the benefit of the American people. Incoming data since our last meeting in March have been broadly in line with our expectations. Economic growth and job creation have both been a bit stronger than we anticipated, while inflation has been somewhat weaker. Overall, the economy continues on a healthy path, and the committee believes that the current stance of policy is appropriate. The committee also believes that solid underlying fundamentals are supporting the economy, including accommodative financial conditions, high employment and job growth, rising wages, and strong consumer and business sentiment. Job gains rebounded in March after a weak reading in February and averaged 180,000 per month in the first quarter, well above the pace needed to absorb new entrants to the labor force. Although first quarter GDP rose more than most forecasters had expected, growth in private consumption and business fixed investment slowed. Recent data suggests that these two components will bounce back, supporting our expectation of healthy GDP growth over the rest of the year. The committee is strongly committed to our symmetric 2% inflation objective. For much of this long expansion, inflation ran a bit below our 2% objective, alongside considerable slack in resource utilization. But last year, with the unemployment rate at or below 4%, inflation moved up. From March through December, core inflation, which excludes volatile food and energy components, was at or very close to 2%. Overall inflation fluctuated from a few tenths above 2% to a few tenths below over this period, with the moves mostly due to changes in energy prices. As expected, overall inflation fell at the start of this year as earlier oil price declines worked through the system. Overall inflation for the 12 months ended in March was 1.5%. Core inflation unexpectedly fell as well, however, and as of March stood at 1.6% for the previous 12 months. We suspect that some transitory factors may be at work. Thus, our baseline view remains that with a strong job market and continued growth, inflation will return to 2% over time and then be roughly symmetric around our longer-term objective. At the start of the year, a number of cross-currents presented risks to the outlook, including weak global growth, particularly in China and Europe, the possibility of a disruptive Brexit, and uncertainty around unresolved trade negotiations. While concerns remain in all of these areas, it appears that risks have moderated somewhat. Global financial conditions have eased, supported in many places around the world by an accommodative shift in monetary policy and in some cases fiscal policy. Recent data from China and Europe show some improvement, and the prospect of a disorderly Brexit has been pushed off for now. Further, there are reports of progress in the trade talks between the United States and China. The committee views these developments, along with the outlook for continued growth, a strong job market, and muted inflation pressures, as consistent with continued patience in assessing further adjustments in monetary policy. Over the past several months, we've made a number of consequential decisions about our balance sheet. In January, we decided to continue implementing monetary policy using our current policy regime, which involves providing an ample supply of reserves. In March, we decided to slow the pace of balance sheet runoff starting this month and to cease runoff entirely in September. These plans support our longer-run dual mandate objectives and also provide clarity about the path of our asset holdings. Today, we had a preliminary discussion about the longer-run maturity composition of the portfolio. Before the financial crisis, our portfolio was weighted toward shorter-term debt of the federal government. In the wake of the crisis, the Fed bought a large amount of longer-term securities with the aim of lowering longer-term interest rates and thus supporting the recovery. Because of these purchases, our portfolio is now weighted toward longer-term securities. As part of normalization, we will have to decide what maturity structure should be, what the maturity structure should be in the longer term. This choice raises many complex issues and has possible implications for the stance of policy. Today's preliminary discussion laid the groundwork for more complete analysis and discussion, and we plan to return to the maturity composition question toward the end of the year. There is no pressing need to resolve this matter, however, and any decisions we ultimately reach will be implemented with considerable advance notice and in a manner that allows for smooth adjustment. As we've often emphasized, adjustments to the balance sheet normalization process may well be needed as the process unfolds. Finally, we made a small technical adjustment in one of our tools for implementing monetary policy, the interest rate on excess reserves, or IOER rate. The change does not reflect any shift in the intended stance of monetary policy. We use the IOER rate to help keep the federal funds rate in our target range. As balance sheet normalization continues, we have expected that the effective federal funds rate would shift up over time relative to the IOER rate. Last year, we twice lowered the IOER rate by 5 basis points relative to the top of the target range after the federal funds rate moved toward the top of the range. These actions helped keep the effective federal funds rate well within the target range. And today, we made one more such change. The target range for the federal funds rate is our main indicator of the stance of policy, and it remains unchanged. Thank you very much. I'll be glad to take your questions.
Thank you, Mr. Chair. Steve Leisman, CNBC. As the statement noted, core inflation now running below 2%. It's been falling for 3 straight months, and while you've been close, it's only been at 2% or above 1 month since 2012. Mr. Chair, I guess I wonder, is it time to address low inflation through policy? And can you give us some sense of your metric for when it would be time? At what level would it require a policy response from the committee?
So first, we are strongly committed to our 2% inflation objective and to achieving it on a sustained and symmetric basis. As I mentioned, we think our policy stance is appropriate at the moment, and we don't see a strong case for moving in either direction. I would point out that inflation actually ran, including core inflation, actually ran pretty close to 2% for much of 2018. As you point out, both headline and core, though, did come in on the soft side in the first quarter, and that was not expected as it relates to core. So we say in our statement of longer-run goals and monetary policy strategy that the committee would be concerned if inflation were running persistently above or below 2%. So persistent carries the sense of something that's not transient, something that will sustain over a period of time. And in this case, as we look at these readings in the first quarter for core, we do see good reasons to think that some or all of the unexpected decrease may wind up being transient. And I point to things like portfolio management, service prices, apparel prices, and other things. In addition, the trimmed mean measures of inflation did not go down as much. Indeed, Dallas trim mean is at 2%. But to go back to your question, if we did see a persistent inflation running persistently below, then that is something the committee would be concerned about and something that we would take into account in setting policy.
Sam.
Thanks very much. Sam Fleming from the Financial Times. Let me carry on the same theme. There's obviously been a lot of speculation in the markets about the prospects for a rate reduction this year. Do you think markets have effectively got ahead of themselves on this? And what sort of economic conditions would you need to see to give serious consideration of a rate cut? There's been discussion, for example, about the 1995 example. Do you actually need to see a looming recession to cut rates, or could an insurance cut be appropriate? Thanks.
So, as I mentioned, we've just come through a 2-day meeting, and we've done a deep dive on economic and financial conditions in the United States and around the world, and thought about our policy. And we do think our policy stance is appropriate right now. We don't see a strong case for moving in either direction. So, we do, of course, though, as a routine matter, as you will know, we look not only at our baseline, but we also look at alternative simulations, both better and worse, and we ask ourselves what the appropriate policy response would be. But that's all we do, and I would just say that we're comfortable. The committee is comfortable with our current policy stance.
Hi, Howard Stein with Reuters. Shifting gears a little bit, I wondered if you could flesh out, I know you're describing it as a small technical adjustment, but on the IOER federal funds spread, give us a sense of why it matters whether or not this breaches the upper limit a little bit. Is there any feed through to broader credit conditions and financial conditions that you worry about, or is it simply a matter of the Fed showing that it can control what it says it's controlling? And I do have a follow-up.
A small temporary deviation outside of the range would really wouldn't be important, as your question suggests. But we do think it's important that we be able to, control the federal funds rate and generally keep it within the range. That's just good monetary policy, monetary control. So, we think it's important, and we have the tools to do that. So we've used them again today. And again, this is just a technical fix. It really has no implications for policy.
But as a follow-up on this, it is demonstrating that you control the market you want to control. And I guess the question is, at what point would these steady declines in the IOER and steady widening of this spread, if it continues, essentially become the policy choice?
Yeah, I mean, so generally speaking, the federal funds rate, we control only directly the federal funds rate in terms of the market rate. And the transmission of the federal funds rate into other short-term rates, money market rates, has been very good over a long period of time. And that's important because it's really broader financial conditions that matter, not so much precisely the federal funds rate. So I think the Fed controlling the federal funds rate is actually important from that standpoint. And I don't see us not controlling it. So I think we'll continue to control it, and it will continue to transmit well into broader financial conditions.
Michael McKee with Bloomberg. I'm curious about the financial conditions that you see out there. The minutes of the March meeting tell us a few officials worried about financial stability risks. Was there a broader discussion at this meeting? Any consensus on whether such risks are growing as the markets hit new highs and we do see some instability in short-end trading? Is it possible that rates are too low at this point?
So we actually have a financial stability briefing and opportunity for comment every other meeting. So we had our quarterly briefing yesterday, as a matter of fact, and had that discussion as well. And I think there haven't been a lot of changes since the last meeting, but I'll just go through the way we think about it. First, we've developed and published our framework for assessing financial stability vulnerabilities, put it out for comment, and welcome any feedback that we get from the public. And that enables us to focus our assessments, regularly on the same thing, so that we can be held accountable and be transparent. So there are four aspects of it that I'll go through quickly. But I'd say that the headline really is that while there's some concerns around non-financial corporate debt, really the finding is that overall vulnerabilities in the financial stability vulnerabilities are moderate on balance. And in addition, I would say that the financial system is quite resilient to shocks of various kinds with high capital and liquidity. But the four things we look at are first asset prices. And as for asset prices, some asset prices are somewhat elevated, but I would say not extremely so. Leverage in the financial sector, I mentioned. Households are actually in good shape from a leverage standpoint. Default rates are low. Borrowing is relatively low. Non-financial corporates is an area that we've spotlighted and focused on for attention. And there are concerns about that, not so much from a financial stability standpoint, but from the standpoint that having a highly leveraged corporate sector could be an amplifier for a downturn. And then the last two things are really about the leverage in the financial system and funding risk, and those are both very, very low by historic standards in the United States. So on balance, in my view, vulnerabilities are moderate.
If I could follow up on that, I'm just curious as to whether the level of asset prices is a reason why you might not be interested in cutting rates.
Yeah, so we do say that risks to the financial system are, we say in our longer run statement of goals and monetary policy strategy, that risks to the financial system that could prevent us from achieving our goals are something that we do take into consideration. I would say that, though, that really the tools for addressing those concerns are better, capital liquidity, good supervision, good stress testing, and things like that. Those are better first-order tools to deal with these kinds of issues than monetary policy.
Nick Tamaros of the Wall Street Journal. Chair Powell, with the benefit of hindsight, did last year's rate increases make it harder for the Fed to credibly affirm its 2% symmetric inflation target is not, in fact, a ceiling? And if so, would it be appropriate to lower rates if core inflation remained persistently closer to 1.5% instead of 2%? And if not, do you worry about any unwelcome tightening in real rates given the recent softness in core inflation?
So to your first question, if you go back and think about the middle of last year, inflation was at 2% and appeared to be staying there. And the economy was quite strong, was growing strong. The fiscal changes were hitting the economy in a very positive way. And so I think the expectation was that inflation would remain up around 2%. The weak first quarter performance was not expected. Of core was not expected, and I don't think is related to anything we did in terms of raising rates. It appears to be more. We don't know this, but you never know until only with hindsight, with perfect hindsight. But some of it does appear to be transient or idiosyncratic. Now, the second part of your question, sorry.
Well, if it was an issue, would it be appropriate to lower rates if core inflation held closer to 1.5%? And if not, are you worried that there's unwanted tightening from real rates being where they are?
Yeah, so as I said earlier, we do address this in our sort of constitutional document. If inflation were to run persistently below 2% or persistently above 2%, that would be a concern for the committee, and the committee would take that into account in making policy. I do think it's important that inflation run close to and sustainably for a sustained period of time and symmetrically around 2%, because if it doesn't, you run the risk that inflation expectations can, if has been the case, most of the misses are on the downside. Inflation expectations over time could be pulled down, and that could put downward pressure on inflation and make it harder for us to react to downturns and harder for us to support the economy in difficult times.
Gina Smilik, New York Times. So as you just mentioned, last year when you guys were kind of getting inflation coming in around 2%, you had this benefit of the tailwind of fiscal stimulus. And you still have that to some extent, although the tax cuts have mostly feeded through. We've still got something in the pipeline from the spending cap increases. So I guess, how do you think about inflation as that fiscal benefit wanes toward the end of this year?
Yeah. Inflation, first of all, month to month, quarter to quarter, is going to move around. There'll always be factors hitting it. So probably the biggest single factor driving it is the rate of underlying inflation, or a closely related idea of where inflation expectations are anchored. The thought being that's where inflation will go in the long run if it's not being pushed by those other factors. So we also think that slack, that the level of slack in the economy does play some small role. It's it's actually still a measurable role. It's nothing like it was in the 1960s when the Phillips curve was quite steep. So that's also something that plays a role. So we take all those things into account, and the part of it that we can control is the slack part. And again, we do expect that this reading will be transient and inflation will move back up. And if it isn't, then if it runs persistently below 2% for a sustained period, then that's something we take into account in setting policy.
Okay, Donna. Chairman Powell, Donna Borak with CNN. Pivoting a little bit about wages. Since 2010, women's real earnings have gone up about 3.9%. Compared to men's, which has risen, about 2.1. Do you think the relative increase in women's wages is a problem for the U.S. economy?
I think generally, I'd have to see the data on that. I mean, it sounds like you picked a particular time frame. Over time, I really wonder whether that's the case. I think men and women should make the same for the same work. By and large. So
just to push a little bit on this, but if the data shows that women's wages are rising higher, is there a damage to the U.S. economy if males' wages are declining or not growing as fast as women?
Yeah, so I think we're getting in here to commenting on a nominee to the Fed indirectly, and that's something I'd rather avoid. It's really not my role to engage with potential nominees to the Fed, so I'm really not going to go there. I haven't seen this research either, so I don't really know. Thanks.
Victoria.
Victoria Guida with Politico. I wanted to ask, early last month, I believe it was April 2nd, the FedWire system went down, and I was just wondering if you could talk about what happened there, how long it lasted, whether you know what happened, whether you're still looking into it, and whether it's something that could happen again.
Sure. So that's right. I want to say it was April 1, but it may have been April 2. In any case, the FedWire did go down for a few hours in the 3 or 4 hour range. We were able to quickly identify the problem. It was an internal problem, and we were able to correct it and make changes so that problem and other problems like it cannot repeat themselves. So we learned from these instances. They're fairly rare, but we learned from them, and in this case, it was internal and it's been corrected.
Steve Matthews with Bloomberg. Next month we have the 10th anniversary of the end of the recession, and there are some countries that have had expansions for 15, 20, 25 years. Do you think that's something that's practical for the U.S., that we could have that kind of lengthy expansion? And for you personally, if we had a recession during your tenure, would you consider that a failure?
I wouldn't want to speculate. There's always the example of Australia that everyone I think is aware of, where I think they're in year 28 of their expansion. So things are possible. I think all I can see is that we have an economy where the expansion is continuing, growth is at a healthy level, the labor market is strong, we see job creation, we see wages moving up, inflation is low, which gives us the ability to be patient, and we do expect it to move up, and we want it to move up to 2%. So I see I see us on a good path for this year.
Do you see the parallels with the 1990s when, for example, some people have pointed out in the U.S. the longest expansion before this one, there was a rate cut in 1995 and the rates went up and then they came down and there was that kind of management. Do you see similarities in today's situation?
Similarities in the length. I mean, the situations were quite different then. This was before inflation really was under control. But it's very interesting to look at the history. I find it quite interesting to look at different periods. But I think in our own cycle, we face a particular set of challenges that are really what's relevant for us now.
Marty, and then we'll go to Paul.
Mr. Chairman, Marty Krutzinger with the AP. You've repeatedly said that the Fed's going to conduct monetary policy without regard to outside political pressure, but it seems like the president is intent on increasing that political pressure. Yesterday, he said you should cut rates a full percentage point and start quantitative easing. What do those comments do in terms of affecting how you pursue policy and how you convey your decisions to the public?
Yeah, so as you know, we are a non-political institution, and that means we don't think about short-term political considerations, we don't discuss them, and we don't consider them in making our decisions one way or the other. And what we're always solving for in our process, in our work, is to carry out our mission, which is to extend the economic expansion, keep the labor market strong, and get inflation around 2%. So to give you an idea of what our process is like, maybe as a way of putting all that in context. So for the past maybe 10 days, all 17 FOMC members will have made extensive preparations, catching up on the latest data, reading all the memos, talking to their colleagues and their staff. As you also are, I'm sure, aware, Marty, we talk to literally thousands of business people and market people and people in the nonprofit sector and the educational sector, and just to get a better sense of the economy. We put all that together, and we come together for 2 days. The first day begins with an economic briefing, which is sort of economic and financial developments in the United States and around the world. That takes up most of the first day, and we talk about this in great detail. We go away, we think about that, and we come back, and the next day we talk about monetary policy. And in this particular case, we came to a unanimous decision after an extensive discussion that our monetary policy stance is appropriate where it is. And we think our monetary policy stance is in a good place, and we're going to be patient as we consider adjustments. So, and we also see, by the way, the evolving risk picture as very consistent with that outlook. So we don't feel like the data is pushing us in either direction. Of course, we'll not hesitate if we do feel that the data justify a move in either direction. But that's our process. That's how we think about things. We don't think about other factors. We don't let them into our decision-making. We don't discuss them.
Paul Kiernan from Dow Jones Newswires. Thanks for the question. In the last 23 years, core PCE inflation has run above 2%, only during a period that coincided with the housing bubble. I'd like to know what you would say to people who worry that it will prove difficult for the Fed to lift inflation without potentially stoking another asset bubble of some sort. Thank you.
Yeah. So, I mean, you're pointing to the fact that in recent years, inflation has moved down and down, and really many major central banks have struggled to reach their inflation goals from below. And that includes us, although we've come closer, I think, than most others. And it's just a question, I think, of demographic and other large and in some cases global forces that are disinflationary to some extent. And it creates significant challenges. One, I would say, is it means that interest rates will be lower, will be closer to the effective lower bound more of the time, because that means lower interest rates. And that's one of the reasons we're having a review of our monetary policy strategies, tools, and communications this year, is to think about that problem. You mentioned the connection to financial stability of lower for longer rates, and that is another challenge. As I mentioned earlier, we do consider financial stability concerns to the extent they threaten achievement of our goals. But we also view, and I do take the view that macroprudential and supervisory tools, regulatory tools, things like the stress tests that we can do right through the cycle, those are really the best defense against financial instability, so that the financial system is highly resilient to the kinds of financial shocks that can happen.
Greg?
Thank you. Greg Rabb from MarketWatch. This morning, the ISM Manufacturing Index had its worst reading since October 2016. So isn't that a dark cloud on your outlook for strong growth for the rest of the year? I mean, how much weight does it hold for you? And is it a sign that monetary policy might be too tight?
So this is the ISM reading, I guess, from this morning on manufacturing. Yeah, I mean, we see that reading as is still a positive reading and consistent with what we expect from the manufacturing sector, which is moderate or perhaps modest growth. Manufacturing has been weak all around the world. Services have been growing faster. So it's something that we're watching carefully, but we do expect a positive contribution to growth from the manufacturing sector.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for doing this. You mentioned, talk about domestic growth a little bit with the economy. You mentioned that the progress in the talks with China trade, progress in the talks with Japanese trade, the USMCA is moving or going to move through Congress. You talk about a little bit of the domestic growth that you're seeing going forward for the rest of the year, and could these trade deals turn into tailwinds for the economy? Our outlook and my outlook is a positive one, is a healthy one for the U.S. economy, for growth for the rest of this year. And I would say that the basis for that really is consumer spending and business investment. So if you look at consumer spending, you saw stronger retail sales, stronger motor vehicle sales in March. And as I mentioned, the conditions, the broader economic fundamentals are strong in support of consumer spending. That's more accommodative financial conditions, high confidence readings, high levels of employment, wages going up. All those things are going to support consumer spending. So that's a significant part of the outlook this year. And business investment should also be positive in that sort of direction. In terms of the effect of trade deals, I think one thing would be that the resolution of the uncertainty around these trade negotiations would, I would guess, be a positive for business sentiment. We have been hearing from our business contacts really a lot since the beginning of the trade negotiations that uncertainty is a concern. If you import metals or whatever for your product or export your product, then it's been a challenge for you. So that would be a positive. And of course, most of the gains, though, I would expect, even from a successful trade negotiation, would come in over time. I don't think they wouldn't be the kind of thing where you'd immediately feel big effects right away, but they could be quite important over a longer period. So I think that's would be my expectation. And I don't know, though. I haven't seen, none of us, at least I haven't seen the details of what's been negotiated.
Don Lee with the LA Times. Getting back to inflation, can you talk more about the transitory factors holding down inflation, how significant they are, and why you think those factors will pass?
Sure. Well, I would just mention a couple. Let me say I don't mean to diminish concerns about too low inflation, but I think there's good reason to think that these low readings are particularly influenced by some transitory factors. One that I would mention is portfolio management services, which would tend to go down when asset prices go down with a lag. And so when asset prices went back up, probably there'll be a swing around there, positive contribution. Other ones that get mentioned are things like apparel, and apparel prices were very, very low. There was a change in the methodology. And another one is, airfares. There are many little things. So we don't know until we see. But
there's reason to think that those would be transient and would turn around. And another way to look at it is there are models that look at inflation in different ways, like not models but measures, like the Dallas trim mean, as I mentioned. So trim mean, it cuts off the big movements on the upside and the downside and looks at just the mean movements in inflation of various product categories and service categories. And it didn't go down at all. It's at 2%, or it's at, I don't know whether it went down, it was above that, but it's at 2% now. So there's reason to think that these will be transient. We, of course, will be watching very carefully to see that that is the case. I would point to the case of cell phone services. Many of you will remember in March of 2017, there was a very low reading of for cell phone services, mobile phone services, and it was kind of a price war, and it dragged down core inflation for a full year, but it did not look like something that would be repeated. And we kind of thought so and said so, and then sure enough, in 2018, we had those months of 2% inflation. So again, we'll have to see here. We're going to be watching, really, I'd like to say we're going to be watching inflation carefully to see that these things are transient. And I'll end by saying we are strongly committed to the 2% inflation objective.
Hey, Nancy. Just following up, Chair Pollack, Nancy Marshall-Genzer with Marketplace. You were saying if inflation does stay low and these low inflation rates are not transient, you said a couple times you'll take that into account with monetary policy. How specifically will you take that into account?
Yeah, it's hard to say because there's so many other variables. I mean, we ultimately there are many variables to be taken into account at any given time, but that's part of our mandate. Stable prices is half of our mandate, and we've defined that as 2%. So we'd be concerned, and we'd take it into account.
So, cut in interest rates would be.
I can't really be any more specific than what I've said.
Jean Young with Market News. If the Fed funds rate keeps rising, do you see room for another IOER adjustment? And then can you speak to any other strategies or tools that might be useful for keeping a ceiling on short-term interest rates? There have been other ideas floated, like the standing repo facility and targeting a different benchmark rate.
If we need to, and as needed, we will use our tools to keep the federal funds rate, somewhere in the target range. We'll do that. Don't expect to need to do it again, but we don't know. I mean, we're with the balance sheet is now the size of it is going to be driven by demand for liabilities, principally reserves, as I mentioned. And we're right at that point where we're starting to learn more and more about what the real demand for reserves is over the next few months. And so there is no template for this. There's no roadmap. We just have to do it, and that's why we're moving so very gradually. It's why we tapered the roll-off to only $15 billion in treasuries per month. Effective, I guess, today, we're cutting the roll-off rate for treasuries in half just because we want to take our time and move gradually here. So that's that. In terms of other tools, we're actually, I'm sure at an upcoming meeting, we will be looking at the idea of a repo facility. I don't have any presupposition that it's something we would do, but we'll be taking a look at it as a possible addition to our toolbox. Again, I wouldn't say it would just be in a way for us to do what we do, which is to do a deep dive on it, think carefully about it, look at the pros and cons, look at the different possible ways to do it, and then go away and think about it for a little while, and then probably come back and make a decision. But that's something we'll do at an upcoming meeting, I would imagine.
Hannah Lang, American banker. On the regulatory side, the Fed and other bank regulators are said to be weighing all options for retooling a proposal to revise the Volcker rule. Can you give any indication how close the agencies are to coming to a solution and what that solution might look like, whether it would be starting from scratch entirely or making changes to the original proposal?
We put out a proposal on Volcker some time ago, and we got a lot of comments, and we're reviewing them carefully. I really don't have a lot for you. I know they're making good progress. I don't really have a date, though. And in terms of what all it's going to be, it's not something I can say with any certainty yet.
there. Brian Chung with Yahoo Finance. So given what you've said about the expectations for consumption and also business fixed investment perhaps bouncing back in the next GDP reading, I'm wondering if you think that continued growth in economic activity might show some sort of underlying fundamental that could flag another overheating. For example, the median projection in the March meeting for GDP growth for 2019 was 2.1. So I'm just kind of curious about what you see going forward if we continue to see strong GDP numbers.
Well, we don't see any evidence at all of overheating, for one thing. We see inflation below 2% now, as I mentioned, pretty close to 2% for most of last year. So really no signs of overheating. If you look at the labor market, for a long time now, there have been anecdotal reports of labor shortages and difficulty in finding skilled labor and that kind of thing. Nonetheless, you have very strong job creation, and you have wages moving up at a rate that is appropriate given inflation and given productivity, but not at all signaling any overheating at all. It's not higher than that rate that would incorporate both inflation and productivity. So really not seeing signs of overheating at the moment.
Okay, Heather, for the last question.
Are wages ever going to get back above 4% in this cycle? Can you kind of give us a read on, but more substantively, can you give us a read on how the committee views productivity growth, if it's accelerating enough?
Yeah, in terms of wages getting over 4%, wages have moved up pretty steadily over the last 5 years and are now, wages and benefits are now between 3 and 3.5%. Just for the last couple of years, the biggest part of the gains have come for people at the lowest end of compensation and education, which is kind of a welcome thing. You mentioned productivity. So productivity is really very difficult to predict. No one has been able to predict it successfully, so I won't really try. But I will say this. Productivity was very, very low in the wake of the crisis for 6 or 7 years. Last year, we had 1.9% productivity, which is much higher. I don't know if that level can be sustained, but we really, it's driven to some extent by technological developments and really the diffusion of technology through the economy, and it's very hard to predict. So I think it's positive. In fact, I'll mention, if we're talking about the supply side, labor force participation. Really, there has been a significant positive supply side development over the last year and a half between the uptick in labor force participation, which goes back, several years, but also productivity. And that does suggest more room to grow. It suggests a less tight economy, a less, maybe part of the explanation for lower inflation.
Thank you.
Thanks very much.